Ray. This is the Wealth Guardian Show. And as always, let me start my show out by giving a big thank you and salute to all of our service members out there for their sacrifices. They go in harm's way to protect us. And also, right now, I want to say thank you and lay up some special prayers to all of our guys and gals in blue out there. You're in a tough spot, tough times, but we're praying for you. All right. If you look at the 10-year chart of the stock market, you'll see that the Dow has come a long, long way since March of 2009. You know, if you can even remember back then, remember how bad things were, how the gloom and doom that you just felt. I mean, it was like a heavy, wet blanket laying on top of you. The Dow was around 6,500. Nobody thought it'd ever get up off the carpet and fight again. But, boy, has it come roaring back. Yeah, we've had some bumps in the road along the way. We've had China and we've had Brexit and, but this stock market's on a tear once again. It's reached all-time highs just in the last couple weeks. Well, it's an amazing situation that we're seeing right now. And that Dow jumped 121 points to 18,348 on Tuesday. It surpassed the previous record set in May of 2015. And then joining the S&P 500 in an uncharted territory. And for the first time this year, even the NASDAQ closed in positive territory. All of this represents a breakthrough for the U.S. markets. Up until recently, they had appeared to have run out of steam. I mean, the last 18 or so months, it was just volatility up and down, churning sideways and out. And, the catalyst for the recent big market gains has been surprisingly strong June jobs reports, which dramatically eased fears of showdown in the U.S. economy that emerged after hiring slowed down dramatically in May. But there's also a side story to that, and I'll step into that in a minute. The Dow is now more than 400 points up since Friday morning. The market milestone came at a surprising time. Just 2 weeks ago, global markets were in a freak-out mode because of Brexit. The UK referendum sent the Dow plummeting nearly 900 points that Friday and Monday. But then all of a sudden, in a parabolic move up, we hit all-time highs. So is now the time to jump into stocks? Many market veterans are advising caution, and one source of concern is that all the hiring in the U.S. could lead to higher wages, which will dent corporate profits. Well, let me address that point. As you've heard me say on this show repeatedly, these jobs numbers are, how we say, massaged a little bit. We don't clearly have a 4.7% unemployment rate. It's down that low because so many people have quit looking for jobs entirely. The job participation rate, I think, is the one that you need to take a look at. And we got 94 million Americans that are either totally out of work or giving up looking for work or part-timers. And in fact, that big jobs report, most of that was part-time work. It wasn't good, sustainable type of, income creating, family supporting work that we've come to expect in this country. So don't let those things, cloud your judgment. And the big run up in the market, let's just call it for what it is. It's not organically grown. It's not because companies are just tearing it up with sales and profits. It is because of central bank intervention all over the world. We've talked about it on this show many times. But if you look at the history here, every time we have a major world event, such as a Brexit, such as the ISIS Paris, Orlando, Brussels shootings, the central banks always come in the following week and support the markets, and that's exactly what they did following Brexit. We've got negative interest rates in 24 European countries. And we've got Japan, not only just in negative interest rates, but now they're seriously talking about helicopter money. More on that in a moment. The other thing that's going on to push this market to all-time highs is because we have such low interest rates, corporate America has been using that to be able to borrow to buy back their own stock. We've had a huge amount of corporate buybacks in stocks. Again, that is not an organically grown fundamental increase in revenue and profits to promote stock prices. In fact, to tell you the truth, if you look at the current PE ratios, we're at 24 times earnings. That's monster big. Some would say even quite overvalued. So the question becomes, how much longer and how high can this market go? And my answer is, I don't know. I am completely surprised we are where we are right now. I have to admit, I've been fooled at how much they could levitate this market and how much froth they could put into this market. But I'll tell you what, I know this, at some point it will end, whether it's tomorrow, next week, next year, or 10 years from now, it'll end. And any time you have markets that have been pushed to such parabolic heights on, let's just call it meddling by central bankers, it always ends badly. Now, if you just joined us, you're listening to the Wealth Guardian Show right here on 94.5 WPTI. You know, I got to tell you a little story about a meeting I had this week. Met a 62-year-old divorced lady, wonderful person. She had been a professional. Well, she's still a professional. She was accustomed to making a six-figure income. Unfortunately, she's been sort of sidelined for about the past year and a half with an ailment, which thankfully she's fighting through that and should return back to work here in the next several months. But she came to one of my workshops, and she's concerned that she has too much of her money in the market right now. She's concerned about everything she's seeing going on, the negative interest rates, the countries that may end up dissolving the EU because they're going to pull their own Brexit, the election year. She reads the paper. She's a smart lady. So she comes in, and I'm looking at her portfolio, and she's got $700,000 in various types of accounts. But 100% of this money is in the stock market. 100%. She's 62 years old. Now, her broker is wild-eyed bullish. I mean, wild-eyed bullish. And I just flat told her, I said, I think that, this could end up being really, really bad for you because, yeah, he's been right so far, but one day he's going to be wrong badly. And is he going to be able to get you out? My experience with them is no, they do not get you out. They let you ride it, but they don't get you out. So, you may have been with the same stockbroker or financial advisor for years, but, friendships aside, when's the last time you formally reviewed your portfolio with them? I mean, are they actively managing your money? Do they have an exit strategy? Do they even have an entry strategy? Are you having conversations with them about your Social Security, taxes on your Social Security, health care, Medicare, long-term care? If you're not, you're missing some critical pieces to the retirement puzzle. And these things could make profound difference on how far your money could go in retirement. And I'll prove it to you with our 5-point retirement master plan. We don't just talk about stocks, bonds, and mutual funds. We give you actionable strategies on how you could pay fewer taxes on your Social Security, how to wring every nickel of benefits out of your Social Security, how and when to withdraw money from your retirement accounts and which accounts to draw from first and last, plus inflation, health care, Medicare, and a whole lot more. We talk about how to make every dollar break a sweat and go further in retirement. Your initial analysis is not going to cost you a dime, and you got nothing to lose. There's no obligation on your part. Unfortunately, I can't do it for everyone. But if you've saved at least $100,000 for retirement, be one of the first 10 callers today on this show at 336-391-3409. Leave your contact information, and we'll schedule your initial analysis. What you learn in this initial analysis could change everything. So to get your 5-point master retirement plan, call us right now at 336-391-3409. Yeah, here we are at all-time highs, and, the question is what to do. I talked earlier about they're actually talking about helicopter money. When we come back in the second segment, I'm going to tell you what that is and what the implications of that are. I'm also going to talk about an alternative strategy that I use quite a bit with my clients. I love this strategy because it's going to keep you in the market. It's going to give you the ability to compete very, very well with the market upside, but at the same time, there is no downside. And we'll talk about that as a good alternative for, maybe it's not for all of your money, but it certainly is, for a good idea for some of your money. And it's not a perfect investment because there's no perfect investment out there. There's warts on everything. I wish I could find you the perfect investment, but right now, that's not going to exist and probably never will exist. But I do sincerely believe that even though here we are at all-time highs, it's time to be cautious. Lots of things are going on out there in this world, and every one of them could have a major negative impact on the market. At the same time, it could have a big positive impact. So what's an investor to do? Well, stay tuned. When we come back, we'll try to give you some examples. You're listening to the Wealth Guardian Show right here on 94.5 WPTI, the Piedmont's news, talk, and sports station.
I don't remember what day it was.
Well, welcome back. I'm Doug Ray, and this is the Wealth Guardians radio program. A recent CNN headline poses a question, is this a bull market or a load of bull? I kind of like it phrased that way myself. Yeah, we were talking in the first segment, this stock market's been on a tear, reaching all-time record highs. But the question is, will this market continue to go up? Or are we just around the corner from the next major stock market correction? One thing's for sure, trying to time this market's been a fool's game. It's been amazing to me because every single technical setup since about 2011 that would indicate we're ready to go into a corrective phase, the central bankers have been able to blow it out of the water through either QEs 2, 3, 4, whatever, negative interest rates. I talked to you about helicopter money in the first segment. We're going to talk more about that. This market really deserves to be thousands of points lower, but it's not. And at some point in time, it's going to get there. So what does all this mean to you? Well, I hope it should mean it's time to be cautious and not wild-eyed bullish. The folks on Wall Street are all wild-eyed bullish. We take measures of that, just like you measure the temperature out there of the day. We know what sentiment readings are like. Generally, when they're wild-eyed bullish like that, it's usually the indicator of a top. Every one of the Wall Street firms out there are going to have you heavily invested in this market. Let me tell you why. Number one is because they are set up to grow wealth over time, and that has proven to be the best way to do it. What they're missing the big picture on is for you folks who are nearing retirement is what a devastating effect of another 2008 or 2000 would do to your portfolio as you enter into the retirement years. They don't get that. They extrapolate everything in a linear fashion. They say the market over time has averaged 9% a year with dividends, and it has. That's not a lie. But they don't take into account what happens to you when you have a 30 or 40% hit that stays down for a couple years and then takes 5 to 6 years to recover. Folks, it's critical that you understand that, and it's also critical that you guard against it in retirement. Doesn't it amaze you just a little bit that here we are at all-time highs when the economy's not that good, when they've had to go to negative interest rates over in Europe and Japan, and they're seriously talking about this thing called helicopter money. Now, what is helicopter money? All right. Years ago, when Ben Bernanke took over as the Fed chief, he had written in his PhD dissertation, it was all about how to avoid another Great Depression. And he outlined all the different tools that the Fed had at their disposal. One of them he termed, or actually I guess the news media termed, helicopter money. But what is helicopter money? Helicopter money is literally giving you cash, money they've printed, and they give it to you. It's just like Ben Bernanke out over your house, hovering in a helicopter, chunking $100 bills at you. Now, we sit here and we think about that concept and we say, no, that'll never happen, not in this country. But let me ask you this. Hadn't a lot of things happened here in this country just in the last several months and few years that you would have said 5 years ago, that'll never happen in this country? Yeah, it has. So can helicopter money happen? I think it probably could. Will it? I don't know. Could we get to negative interest rates in this country? Possibly. I said earlier in the year, we held a state of the market early 2016 for our clients, and the question was posed by one of the attendees, do I think we'll get to negative interest rates in the United States? And I said, no, I really don't think so, but I've got to tell you something right now. I don't know. I really don't know. I see every day the probability that could possibly happen. So what do? What's an investor to do? Well, I'll tell you one thing you can do. You can start doing some homework, and I'll lead you to an area where you can start. You can go to my website at www.thewealthguardians.com. We've got a load of information available for you there. It's totally free. We've got white paper downloads. It's on Social Security, retirement planning, tax-free planning, Roth planning. If you go to the radio tab, you'll find a lot of our radio shows that are there. You can go back and review what Tim Wood has had to say about the market. Our guest last week, Bob Rainier, that was a great show. I enjoyed that with him. That's on there. So start doing your own homework. Now, if you just joined us today, you're listening to the Wealth Guardian Show here on 94.5 WPTI. And we're talking about the market at all-time highs and what that implication means. Are we going to go higher or are we going to go lower? Do you ever wonder, now that the Dow is at an all-time high, should you still be invested in the stock market? Have you ever wondered how and when you should claim your Social Security benefits? And how much you should withdraw from your retirement accounts every year to avoid what could be thousands in taxes, penalties, fees, and so forth? Or how you could prevent an illness from becoming a financial catastrophe? Well, if you've wondered those things, you're not alone. Get those answers. Get those and more with our customized 5-point retirement master plan. This plan is going to show you how to make the most out of every nickel you save for retirement. Unfortunately, I can't do it for everybody. As I said earlier, I'm going to give the first 10 callers on this show today, and it won't cost you a dime. It's in the initial analysis. You got nothing to lose. There's no obligation, but you got to be the first 10. If you saved at least $100,000 for retirement, be one of those first 10 right now and call 336-391-3409. That's 336-391-3409. Leave your contact information. We'll get back with you to schedule your analysis for you. It's going to be the best investment you'll ever make. It's an investment for you and your family. And the only investment you'll make is your time. I promise you that. You know, a moment ago I said I really am not certain anymore if we're going to see negative interest rates in this country, but things are happening out there that make me believe we will. Just this Monday, negative interest rates actually hit North America for the first time. The Canadian Imperial Bank of Commerce, it's the first bank outside of Europe and Japan, issued negative rates Monday. They sold $1.79 billion of a 6-year bond with, get this, a minus 0.009% rate. That means, folks, you pay the bank to hold your money. You get nothing in return. Can you imagine that? I mean, that makes zero look pretty good, doesn't it? Who would have ever thought zero return on your money would be a good thing? And you know, what this is doing is it's really forcing people into the stock market. Maybe you don't even want to be there. Maybe you're afraid of it, but at the same time, you don't want zero on your money. You want to get something. So you're forced to put your money in the market. And, you know, we've been seeing the fundamentals of this economy start to roll over now for over a year. You know, profits and revenues are down. And they've been monkeying around with the profit numbers, but the top line number, the revenue number, that's one you can't monkey with. Sales are what they are, and you can't mess with them too much. But we're seeing that roll over, and that indicates to me that we are in a topping formation of some sort, a big one, yes. You know, the fact of the matter is, when we've had 3 quarters in a row where we've seen earnings decline on the S&P 500 stocks. Now, that's happened 17 times in history. And out of that 17, 14 of them resulted in a bear market. If nothing else, it's time to be cautious. Now, let me tell you something that I like a lot, an idea I like a lot. I teased this earlier in the program. I'm using this tool for a lot of my clients. It's not perfect. Like I said before, there's nothing perfect out there. But this tool is completely safe, totally safe, but at the same time, it gives you the opportunity to get some of the upside of the stock market. It uses an index. It is an indexed annuity, but it's a very, very different hybrid type of indexed annuity. It has an indexing strategy that I really like a lot. It's not indexed to the S&P 500 or even the Dow or the Russell or some foreign index. It uses an index that Professor Bob Shiller had a hand in creating. He used his Nobel Prize-winning CAPE strategy, which stands for Cyclically Adjusted P/E Ratio. And the index has been built by and managed by Barclays Bank. In fact, right now, if you want to, go Google it. It's the Shiller-Barclays Index. There's a ton of information on it. But that index has blown everything out of the water in terms of performance. Now, here's a fact that you may not know. The unmanaged S&P 500 index has historically, over time, outperformed 90% of all funds, mutual funds, and fund managers. Yeah, every once in a while you'll get a manager to get a hot hand and outperform it for 2 or 3 years, but the S&P 500 has outperformed them all. Now, the Barclays Shiller Index has outperformed the S&P 500 by a long margin. Now, in my tool, you're not going to get all the upside. Right now, you're going to get 85% of the upside, but none of the downside. Now, I would trade 85% of this Shiller Index for none of the downside of the stock market in a New York second. What I'd like for you to do is to come in and let me prove it to you, because I can put on my smart board a graph of the S&P 500 and a graph of this Shiller Index, and I can prove it to you in black and white, the performance. So all you have to do is call us and set up your appointment, 336-391-3409. That's 336-391-3409. And again, I challenge you, Google it, get some information on it. It's called the Barclay-Shiller Index, and then come in and let's sit down and have a cup of coffee and chat about it. Hey, thank you so much for tuning in today. You've been listening to the Wealth Guardians radio program right here on 94.5 WPTI, the Piedmont's news, talk, and sports station.